Hi everyone, I'm Matt from Looking to Bitcoin, and today we're going to be going over a derivatives trading strategy you could implement to try and improve your trading profitability. To do this, we'll be using a number of resources that are all freely available on lookintobitcoin.com, your number one source for Bitcoin information. And if you haven't already, don't forget to like the video, subscribe to the channel, and turn on notifications to ensure you're receiving all of our content as soon as it is released. So right now we're just on the Bitcoin open interest chart here on Look into Bitcoin. And what we can see here is the Bitcoin open interest. Now, open interest is the current volume of derivative contracts that are being traded across a number of Bitcoin exchanges. So what are derivative contracts? So derivative contracts, as sound, are a derivative of the underlying asset they are trading upon. So Bitcoin derivatives, for example, are trying to mimic the Bitcoin price, but allow users to trade with leverage or short the asset, which is betting on the asset price actually decreasing. So these derivatives give traders a chance to increase their exposure or do things that maybe aren't necessarily possible by just trading Bitcoin on its own. And we can see here with the Bitcoin open interest chart, there is definitely some correlation between the open interest and the underlying Bitcoin price. And when we see this Bitcoin open interest increase substantially, it indicates that a lot more people are betting on what Bitcoin's price may do next. And when we see this decrease substantially, it indicates that a lot of people are potentially closing out their positions or they're reducing in value. But this Bitcoin open interest chart actually has two settings, and my favorite is the BTC denominated open interest, as this isn't so much impacted and influenced by the underlying price of Bitcoin. And what we can see here is times where the Bitcoin open interest is increasing is indicating that a lot of people are betting on the next Bitcoin move could be. So for example, here when we had a very much lack of volatility, when Bitcoin's price was very boring and sideways, maybe people were getting a bit anxious and itchy to actually trade on bet on what the next Bitcoin move would be. So we see a massive increase in Bitcoin's open interest. And once we actually got the move to the downside, unfortunately, we saw the Bitcoin open interest decreasing. And as we said, there is somewhat of a correlation between the price and the open interest, as usually once there is a huge amount of volatility or lack thereof, there usually is more people wanting to bet on what the next move would be to try and maximize their profits. But this indicator alone might not be the best to trade upon, so we need to implement another derivatives data point we have here on lookintobitcoin.com to try and come up with a profitable trading strategy, and that is the Bitcoin funding rate. Now, these funding rates are also tied to the derivatives that people trade for Bitcoin. Now, these funding rates are calculated through what are called perpetual contracts. So again, rather than trading actual Bitcoin, people are trading these derivatives of Bitcoin that are trying to mimic the price. And as these perpetual contracts, again, allow users and traders to actually leverage, which is increasing their exposure to the market by essentially borrowing money to trade with a larger capital than they otherwise would, or again, shorting the market, which is betting on that going down. Sometimes these perpetual contracts lose their actual peg to the underlying asset. So if we see the perpetual price increase substantially above the underlying spot of Bitcoin, we see this funding rate increase. So traders trading long positions actually have to pay a set fee or funding fee to actually allow their position to remain open. And these try and incentivize traders to take contrarian positions to the market. So when we see incredibly high funding rates, it means that the perpetual derivative contract has a substantially different price to the underlying cost of Bitcoin, and therefore it's punishing traders for having long positions open, and vice versa. When we see incredibly negative funding rates, it means that a lot of traders are betting on the price of Bitcoin going down. Therefore, we see the perpetual contracts decrease substantially from the actual underlying price of Bitcoin, and therefore people who are short Bitcoin or betting on Bitcoin's price decreasing further have to pay these funding rates just to keep their positions open. Now, that may have all sounded a little complex, so if it was, I'd recommend coming here onto lookintobitcoin.com, scrolling down and getting a little bit more info beneath this chart here on how these funding rates are actually calculated and implemented. But again, what we can do on this chart is rather than having it as USD denominated, we can have coin denominated. So we can actually see the funding rates in Bitcoin denomination as opposed to USD, which is my preferred way to actually use these data points, as it isn't as influenced and impacted by the underlying price of the asset. And again, you can actually isolate by certain exchanges, but for now we'll just keep it on the average. But we can see once again that these funding rates do have a strong correlation to the underlying price movements of Bitcoin, and a parallel correlation, which means they both do a similar thing at the same time. So once we see a stark decrease in the Bitcoin price, we usually see the funding rates go extremely negative, like we did with the FTX insolvency here. And once we see Bitcoin massively increase exponentially in price, we usually see prolonged periods of very high funding rates. So how can you use these data points to actually create a profitable trading strategy? Well, I think if you use both of them together and look for the extreme examples of when an open interest is incredibly high and funding rates is an extreme either positive or negative value, to take a contrarian stance against the general market. So as an example, we'll take the FTX collapse we saw in Bitcoin's price here. And before that, we actually saw a huge increase in open interest. So this indicates that a lot of traders, a lot of retail traders are trying to bet on what the next move in the market will be. And because there is this huge amount of interest, imagine a spring being coiled in, eventually it has to be released and we're going to see this volatile move. So if we then go back to the funding rates, we could see here that as this open interest was building up, we had a lot of uncertainty in the funding rates. A lot of people were potentially betting on short positions, a lot of people were taking long positions. But once we actually got the move, which was to the downside, we saw this incredibly negative funding rate, which is quite an anomaly and a rare occurrence in the Bitcoin space to have a negative value this extreme. So once we actually saw the open interest decrease substantially, an incredibly negative funding rate, the best thing to do, like we said, is to act as a contrarian to this. Because if people are paying an extortionate amount just to keep their short positions open, it usually indicates that the market is very much oversold and there isn't too much more space to the downside. And the same is true for the upside. And again, once we saw open interest building just a few weeks ago, we could see here that Bitcoin's price was rather stagnant after a big run up in price. And as we look at the Bitcoin funding rates, we saw that there was a huge amount of people trying to take long positions, but this was already after Bitcoin had moved up a rather large amount. So this maybe was people a bit late to the party trying to jump on the train once it already left the station. So following these huge amounts of funding rates, we had Bitcoin's price actually decrease by about 12%. So a fairly stark decrease. And once we actually had that move, we saw Bitcoin open interest decrease. And after that, we saw negative funding rates as people tried to short, anticipating even lower prices. And again, we saw Bitcoin react in the opposite direction and move to the upside. So just to summarize, once we collate these two data points, use them as confluence, the derivative data we have on lookintobitcoin.com, we can get a good general idea of how the market is positioned and what they're anticipating the next Bitcoin move to be. And historically, there has been an inverse correlation between funding rate extremes and the Bitcoin price action that follows. And especially once we see a huge amount of open interest, that indicates that there's so much potential for a big volatile move in the Bitcoin space. Those are a great opportunity to jump on, as they usually indicate a potential turning point in the market. And even if you're not much of a Bitcoin trader, these are still very useful periods for long-term Bitcoin and cryptocurrency investors. As these huge anomalies we see in derivatives data occur, they allow for potentially accumulation during pullbacks during a bull market, or potentially if you are more of a trader, you could actually add to your short positions during a bear market, as we see extremely high funding rates, which maybe are a bit of a discrepancy against the general trend of the market. If you like this video, then please visit lookintobitcoin.com, where you can also consider becoming a site subscriber to gain access to live chats, in-depth newsletters, indicator alerts, private TradingView scripts, and more, all for a fraction of the standard industry price. And let me know in the comments down below and on social media what your favorite tools are for intra-week, intra-month, intra-day trading, perhaps, especially when we can use some more on-chain derivatives-based data and not just mindless speculation. I look forward to reading and replying to all of them. Thank you very much for watching, and I'll see you in the next one.